And so that's why I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally, on the dollar, and we're bottom here and can go higher.
What's up, everybody? It's LG Doucette here, and welcome to the Milk Road Show, the daily crypto show that brings on the only man alive who can call the Fed chair a towel boy, predict a market wipeout, and still sleep like a baby. Arthur Hayes is here. Today is November 27th, 2025. We're recording on the afternoon of the 26th, and magically, Bitcoin is back above 90K, but who knows for how long. Last week, Arthur dropped a monster essay titled Snow Forecast, where he basically told us that the dollar liquidity is falling, Bitcoin is reacting exactly as it should, and yes, 80K is in play, which happened a few days after he called it. And he also called for a nice rip to 250K. And I want to know what his timeline is on that. I want to know what the hell's going on, man, because a lot has happened since he came on the show a month ago. Before we start, listen, today we're kicking off, or yesterday we kicked off our Black Friday offer. For the next week, you get 40% off all access. That's Crypto Macro. And now AI Pro, which is launching very soon. The three biggest investing trends of our lifetime rolled into one 40% off plan. Upgrade before midnight on Cyber Monday to lock in serious investing intel across all three verticals at a serious discount. Today's episode is brought to you by Bridge. Power your business with instant stablecoin payments, no friction, no banks, just global finance made simple. Blocktrust IRA, let AI outsmart the market and grow your crypto while you sleep. And Reserve DTFs, get exposure to the entire crypto market in a single token. Arthur, you're back. Dude, what is going on, man?
I'm feeling good.
You're feeling good. You called that 80K and you are proud of that, I bet.
Absolutely.
Okay, well, listen, you had a fantastic essay last week that had it was a snow forecast, and we didn't know the snow forecast was for a couple days from then. Some magic November snow, which is always very nice for people that care about skiing like you do. What has flipped for you? Let's say even since your last appearance a month ago, or even before the crash, the October crash. What has flipped for you in the liquidity picture that the market is kind of maybe getting wise to now?
Well, I think if you take a look at, I have an index on Bloomberg if clients have access to that. It's the US dollar liquidity index, and it's essentially a combination of certain indicators on the Fed's balance sheet, which was published every week, and then certain indicators from the US commercial banking system. And the reason why, at least in 2025, I've been really focused on the United States is the other three large money printing protagonists, the EU, Japan, and China, haven't really been doing all that much. And it's really been about the United States and everyone's reaction to what the United States has done. And so that's why I've really focused on this particular economic block for, the whole year. And when we talk about the dollar liquidity, my chart basically showed that, year to date, there's been an actual reduction, a net reduction in the amount of dollars circulating, at least by my index that I look at, and I use to guide my investing over the year. But what we saw from sort of April 9th until, October was Bitcoin hitting an all-time high. And this was driven by, I think, people misunderstanding what's going on in the ETF space, especially the IBIT ETF, the BlackRock Bitcoin ETF, the largest ETF out there that tracks Bitcoin, and the digital asset treasury company space, the DAT space, and the issuance of debt and stock to purchase Bitcoin. And these two things essentially added the impression that there's this big institutional bid for Bitcoin, and therefore the Bitcoin sort of ignored the fact that about $1 trillion was removed from the dollar liquidity markets at least from July until the present. And basically, once the ETF inflows switched to net outflows and DAT companies went from trading at premiums to trading at par, if not a slight discount, then Bitcoin basically fell down to where it should have been based on the dollar liquidity situation.
Right. So you're saying that once those kind of, I don't want to call them vanity metrics, but maybe you can tell me how to label them, but things like the ETFs and the DATs, once those got exposed by weaker price action, that basically they quickly kind of cascaded down. Is that kind of what you're telling me?
Kind of. I mean, take the ETF, for example, because this is one of the most shown charts that inflows every day on X and other social media platforms. And people say, hey, look, Wall Street, retail, they're piling into these ETFs. And yes, that is true. But as traders and investors, we care about who is the marginal buyer and seller of a particular asset. What are the flows? And so, I have my trusty Bloomberg chart up here. You put up an HDS, the largest holders of the IBIT ETF on Bloomberg, or whatever platform you use. You'll see, and I'll name them here: Brevin Howard, Goldman Sachs, Millennium, Avenir, Jane Street are the largest 5 traders of this thing. Right? There's a chart in my recent essay.
That's right.
And if you understand anything about what these businesses are, they're either multi-strat pod shops who trade hedge funds, they're global investment banks, and one of them is a family office for the founder of Huobi, Avenir. And so these entities are not places where they're just going to go long Bitcoin. Like Izzy doesn't give a fuck about Bitcoin. Alan Howard loves Bitcoin, but it's not like the key thing in his Brevin Howard asset management company where he manages clients' money. What they're in the business of doing is borrowing money and finding great ways to deploy that with high Sharpe ratios. And that would be a basis trade. So what are these guys doing? They're taking the IBIT ETF, they buy it, they pledge it with their broker, then they sell a futures contract on the CME against it, and they were making, let's call it 7 to 10% per annum on that trade. They fund at Fed funds at, 4-ish%, and they lever it up, and that's a great levered return for these type of investors. Now, as that funding rate declines, and it has declined in September and October, then these traders unwind this position by selling the ETF and buying back their futures contracts. So during the summer, we saw massive net inflows driven marginally by these large players. And then as soon as that basis fell, especially after October 10th on the massive liquidation event, then you see net outflows. And so the retail thinks, oh no, institutions love Bitcoin in the summer and now they hate it in the fall. Therefore, I need to get rid of my exposure as well, not understanding what was driving those flows in the first place. And then on the DAT space, if you have a low MNAV or even at a discount, it's very difficult to issue corporate securities and purchase Bitcoin in a net positive accretive manner for your stock. And therefore, either you stop doing it altogether, you slow down, or you start selling Bitcoin and buying back your shares if you're trading at a discount, which again removes this impression that there's this new cohort of assets or of capital that is coming into the Bitcoin space. So when we remove those two things, and then I post that, you posted my chart of the difference between the price performance of Bitcoin and the percentage change in the dollar liquidity, then Bitcoin says, okay, I'm going to react to where I should have been absent the shimmer of these flows. And that's the move from 125,000 to 80,000.
Okay. That is really well explained. I have a question about those funds, though, the ones that you noted were the biggest holders of IBIT, and they were basically profiting off the funding percentage. What else do they do with their money, and why is this like the best place for them to get a 7 to 10%? Like, is it so they only come in when there's this kind of opportunity, and then they just go back to stables?
No, there's
again.
There's a pod, and a pod has a funding strategy mandate, right? These guys have equity, long, short. They have all sorts of different strategies. There's a portfolio manager, and their team will put on these types of funding trades. Could be bond RV. This is, it's a basis trade. It's a very standard trade, across all different types of ETFs that you can do. I buy the ETF and I short a future on the underlying and I trade the difference. And this is like, I used to do this as a career back in the day as well. So it's a very easy trade, especially when you can fund very cheaply at Fed funds. And then essentially you double the interest rates that you receive and you look like a hero because again, you're just trying to make 10%. If you make 10% for Izzy, you're making $50 a year. So this is what you need to do.
Right. Yeah. So and that funding rate goes down. Why? You said that already, but I just want to understand that.
As the price declines, then the funding rate collapses.
Okay. So it's the price action that affects that, and then people see negative outflows, and then people freak out. Retail freaks out, or whoever the other next participants are, and then you have like a further cascade of price basically. Correct. So if you're listening to Arthur right now, thinking, wait, how am I supposed to know any of this? You're not alone. And that's why we built Milk Road Pro, where we translate this stuff so you're not trading blind. With Pro, you get breakdowns across crypto, macro, AI, you get the full Pro portfolio, and you get like almost weekly AMAs with our experts. So you can literally just ask them what they think is going on. Plus you get Discord access to them and all these weekly reports. It's so loaded, and it's 40% off for Black Friday just this week until Monday at midnight. Check it out in the description. So those ETF flows, I think that this is a really interesting topic, is that, clearly they're misunderstood. What percentage of the ETF like inflows and outflows are these types of funds? And I guess what's the other percentage?
I mean, I don't
What's
know
the other
I don't know
stuff?
the percentage. I don't know
Yeah.
the percentage, but just judging by the type of firms that are in the top five, I know
Yeah.
that they're not long only investors of crypto. This isn't like it's Texas Teachers or XYZ or Ontario Teachers Pension Fund buying Bitcoin if they're the number one holder, right? If that was the case, then my argument would not be valid. But when you have Brevin Howard, Goldman Sachs, and Millennium as the top three holders, they're not in the business of taking just going long Bitcoin. That's not their business. Their business is doing these types of trades.
Okay, I got it. Nice shout out, Ontario Pension Teachers Fund, former owners of the Toronto Maple Leafs. Arthur, what I really wanted to ask you too, and in this article, you're kind of telling a story that something similar happened, towards the end of the last bear market, and that we're looking at a similar setup in the second half of 2025 as we saw in the second half of 2023. Can you maybe explain that to me a little bit more? Because you were kind of making a point about the TGA and how that works in terms of liquidity. I think I just want to understand that a little bit better.
So in 2023 and in 2025, there is a political theatrical fight about the debt ceiling in the United States, where both in 2023 it was the Democrats in charge. In 2025 it was the Republicans in charge. Same issue. One side wanted to spend a bunch of money and raise the ceiling. The other side tried to feign that they gave a fuck about fiscal responsibility, and so they fought the opponent. And then at the end of the day, of course, the government's not going to go bankrupt itself by not paying out, so they raise the ceiling. But all the while that this fight goes on, the Treasury has to spend down its checking account. And when the U.S. Treasury, or any Treasury department for that matter, spends down their checking account, they're adding fiat liquidity to the system. And so this helps the markets. But as soon as the ceiling is raised, now the Treasury needs to refill its bank account. And by doing that, they issue debt. And instead of spending that money that they raise from the market, they keep it in the bank. And that extracts liquidity. So in 2023 and in 2025, it was June in 2023 and July in 2025, you had in the order of, half a trillion to $1 trillion that needed to be raised by the U.S. Treasury. And so as they start to do this, then the dollar liquidity contracts, and this has an adverse effect on all types of risky assets, Bitcoin and stocks predominantly. Now, in 2023, this led to sort of a 20% sell-off pretty quickly in the S&P. The 10-year yield was rising almost close to 5%. And again, the goal of every administration in the United States and every government around the world is to keep the stock market high because they earn taxes and makes the rich people feel good and all these sorts of things. So Janet Yellen had to find a way to juice the markets. Now, back in 2023, there was this facility at the Federal Reserve called the Reverse Repo Program, and it had $2.5 trillion of funds basically left over from the COVID stimulus era that was sat inert on the Fed's balance sheet. So what Janet Yellen did was said, okay, I'm going to issue more Treasury bills, short-term Treasury debt, less than 1 year maturity, and such a quantity that the yield is going to rise so much so above the reverse repo yield that it'll entice those funds to take that money out of the Fed's bank account and put it into the financial markets by lending it to the U.S. government, which then goes and spends this money. And so from 2023 third quarter until essentially January 2025, Janet Yellen's Treasury injected $2.5 trillion of liquidity into the US dollar money markets. And that is essentially the reason why everything across the world ripped. Bitcoin, stocks, gold, housing, whatever, right? That is the reason for that bull market. And that sort of ended in early 2025. That's important because when U.S. Treasury Secretary Scott Bessent under President Trump in the United States did the same thing starting July 4th when the debt ceiling was raised. He had to raise $1 trillion to refill the Treasury's general account. He didn't have this reverse repo program with $2.5 trillion sitting in it to tap to basically nullify this negative liquidity effect. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets. Now, in the stock perspective, it's really the AI hype and bubble that's kept the stock market elevated. And in Bitcoin's case, it was the ETF flows and this DAT flows that we just spoke about that really counteracted this negative liquidity effect.
Okay, so and isn't that TGA amount rebuilt now? Don't they have $1 trillion now ready to deploy, or is that incorrect?
Yes. So now it's essentially it reached about $1 trillion. What at the time of this recording, they haven't released their most recent weekly updates. I don't know where it is now, but last week it was about 900 billion, coming down slowly. So the TGA will probably go to something around 850 billion, which is the target that the Treasury set for how much they're going to keep at the Fed. But more importantly, especially for this time around, it's the cessation of quantitative tightening at the Fed. So this program that the Fed started running in 2022 of reducing their balance sheet is over. Now the balance sheet will be kept constant. And obviously, most analysts believe that the Fed is going to restart quantitative easing at some point for whatever justification that they give. It doesn't really matter. All we know is that we have essentially bottomed on the liquidity chart, and the direction in the future is higher. And so that's why I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally, on the dollar. And we're bottom here and can go higher.
Stablecoins are the biggest use case in crypto right now, but let's be real, using them on chain is still way too complex. That's exactly the problem Bridge is solving. Recently acquired by Stripe, yep, that's Stripe, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Explore the future of global financial infrastructure at milkroad.com/bridge.
Bitcoin changed the investment game. Now AI changes the strategy. Crypto's wild ride demands perfect timing, selling before drops, buying as it climbs. While most investors panic, sell, or hope, a select few leverage a crucial edge: AI. Blocktrust IRA's trading platform spots market patterns with precision no human can match. Since 2020, their Animus AI platform has outperformed Bitcoin by over 250%. Visit milkroad.com/blocktrust today to get up to $2,500 in bonus crypto and transform your investment strategy. Doesn't everybody know this though? Like this is what I'm curious about is that, if even, and again, you're very sharp, right? So it's like you calling 80K before I saw other people call it, like, that's good. Of course, that's what you do. But something like this, like the TGA, you can't hide like a near $1 trillion, right? And especially if that's like something that had an obvious positive effect last time on the market, and that's getting ready to be deployed and quantitative tightening is ending. Why are we still sitting at 90K?
Well, I mean, I guess it's about we still don't know how they're going to create another $10 trillion, right? It's still a question. Oh, is the Fed just going to sit on their hands? Are they going to not raise rates? What's the Trump administration going to do? There's question marks about how effective Trump can be to increase the amount of credit within the system. Now, he said a lot of things, right? And he said, oh, the banks are going to lend money to all these projects, building weapons, nuclear, semiconductors, what have you, right? He said that he's going to, get a new Fed chairman in, and they're going to reduce the price of money, and they'll support the markets with liquidity. He said he's going to pump the housing market, right? He's just a politician. He says a lot of things. Whether or not he's actually able to do them, that's the question that the market has. Once we actually start to see things actually happen, then we'll start to see people price a bigger forward on where this dollar liquidity situation is, and risk assets like Bitcoin will accelerate their rise in price.
So does he have any options other than to print money to create that? Like, are there any, because I feel like there's things being done in the economy, the macro, that it's like, these are like reserved for rare instances that are being done all the time now. What other options do they have besides just to inflate more?
I mean, they're always printing money. The question is how they do it. Now, we've been talking about the Federal Reserve. I also monitor the commercial banking system, and starting in November, the thing that I monitor is other deposits and liabilities, and the amount of securities that the commercial banking system holds in the United States. That sort of bottomed, and we're starting to see an uptick in bank lending. And that makes sense if you read the headlines. JP Morgan's talking about $1.5 trillion of lending they're going to do to the industrial sector. The U.S. government is talking about industrial policy where they'll guarantee a certain amount of purchasing power of rare earths, semiconductors, what have you, to inspire entrepreneurs to build things and get a bank loan to do that. So if this, industrial revolution financed by the banks, this is what Besson and Trump campaigned on. This is what they want to do. They still haven't been able to really start actualizing that. But I think in 2026, we're going to see more evidence of that. Then we're going to see more credit creation coming from the banking system rather than the Federal Reserve. But the fact that quantitative tightening is ending is very important because at least we don't have this drag of the Fed removing something somewhere to the close of, I think, $2 or $3 trillion from the system from 2022 onwards.
Got it. Okay. So you think that once these, I guess, elements start to happen, that we're going to see a like pretty sharp reversal, especially for risk assets like Bitcoin,
Correct.
to the tune of 250K by the end of the year, even this year still. Do you think that's still like there's what are we? It's November 26th, man. You're talking 34 days, 35 days.
I'm gonna stick with it. You know, if I'm wrong, it doesn't matter. That's the
If we hit an all-time if we hit an all-time high by the end of the year, would you feel that you were right?
No, I mean, if it's either 250 or not, like, but I don't really care. I'm long, right? I'm still happy either way.
So that's wild. I love it. I love the ambition, man. 2x the all-time high on a $3 trillion asset. That's good. Yeah, we're ready for it, man. I love that. Okay, well, speaking of, let's circle back to crypto, man, because I think that's we're a crypto show and we want to know what's going on with your crypto, and most importantly, I think this has been a pretty hectic period, right? Fear and greed. I don't know why we still look at this fear and greed little gas meter every day, but we do. It's in the single digits, or it was the other day. People saying this is worse than COVID. This is worse than tariffs. What the hell's going on in these times, Arthur? Like from the October 10th crash to today, what are some of the biggest lessons that you think crypto traders are still learning or still haven't learned?
I don't think people understand the amount of effort that it takes to be a leveraged trader. I think people see, I can get 100x leverage or whatever trading crypto versus I can get 2 or 3x trading stocks or some leverage ETF. This is great. I'm going to make a lot of money. But they're not willing to put in the effort to be a professional trader. But that would I mean like 24/7 on your phone. Like you live and breathe these crypto markets. People think that I'm going to get off of work and trade leverage crypto for a few hours and I'm going to somehow make money. No, you're going to get liquidated. If you're just trading crypto a few hours a day, you're not reading, what is an automatic deleveraging event, how do exchanges mark your positions. And you don't understand these idiosyncratic things about the market structure that you should as a proper professional trader if you put all your effort into this. And that's where most people got wrecked in October 10th. It wasn't some conspiracy by CZ and Binance and the market makers to take away your money. It was you were lazy. You didn't read the documents that have been up for years. I mean, I invented this shit 10 years ago. We wrote about it. You shouldn't have no excuse not to know what this stuff is and how it works. And if you didn't agree with the exchange policy, you should never have been trading it. So I have no sympathy for people who lost money in October 10th, except for people who had API issues on Binance. There's no excuse. If you are a proper trader, you should not get liquidated, period. End of story.
If people were heavy in perps, do you think it's because of a lack of other more fun things to trade this cycle? Perhaps there's no NFTs this time. The meme coin trade has been kind of dead for like a year. Is this just a bunch of people who are like, listen, I got nothing left. I still can't. I'm not winning on poly market. I'm gonna go leverage.
I just think it's
something 10x.
It's just a maturation of the market. There's more people trading these things. There's more newcomers. They haven't decided what they want to be. They're a hobbyist. I get off of work. I trade crypto. I think that I can grind the chart and I'm going to make however much money I'm going to make and it's going to change my life, which it could if you're very, very lucky. But if you don't put in the effort, like I described, then you will get wrecked, period. And you're not reading the documents. You don't understand the flows. You don't understand how these products work. You don't understand the math, yet you think that somehow you're going to make money in this. And so I think that it's a misalignment of expectations versus effort that people are going to put into this thing. Being a professional trader is a job. And if you approach it like that and dedicate yourself to it, then you can be successful.
Okay, if that part that Arthur just said hits a little too close to home for you, good. It should. The market doesn't really care how busy you are or how kind of good your intuition is. And that's why we created Milk Road Pro. So regular people don't get absolutely nuked by the same mistakes that Arthur's describing right now. Pro gives you the research, the portfolio, weekly AMAs, the full toolbox to make good decisions, even in times like these. And it's actually 40% off this week, way cheaper than it usually is, only until Monday at midnight, part of our Black Friday promotion. So check out the link in the description. Right. Yeah. Well, it's definitely very difficult for some people, I think, to resist. Let's put it that way. Last time you came on the show and we were speaking with Jay, you said that a lot of the high quality altcoins, I don't know if high quality is exactly what you said, but a lot of the altcoins, the slightly better ones, let's say, would probably never revisit some of the lows from 1010. And I think actually some of them have. Has this, like, at what point do you think maybe your view on the liquidation of those alts like changed from, right after 1010 to now? And have there been any surprises in terms of which ones have cratered the most?
I mean, I was very thankful that, I know people track some of my smaller wallets, that some of these coins did revisit those lows. Because I basically, when I changed my view as to, constructive on market risk a few days ago, I was able to go in and pick up things at prices that I haven't seen since, April of this year or before then, right? And I look at the charts, like, okay, this is the low that it's ever reached. Great, I'll buy some Pendle, I'll buy some Athena, I'll buy some EtherFi. Great prices, because people sort of got smoked on 1010. And these are projects that have buybacks. These are projects that are profitable. These are projects with users, and they're trading at great prices. So I'm very thankful that they did revisit those prices, because I was able to buy things at what I think are very affordable and cheap prices relative to where they should be, given the fundamentals of the cash flow that these things generate.
Are you buying ETH?
I'm not buying ETH right now. I have a big ETH bag of ETH. I think these things will outperform ETH in the short term.
You think the alts will outperform ETH?
Yeah.
Okay. Which, like some of the ones you mentioned, like ENA and stuff like that.
Yeah, exactly.
Okay. Do you still think ETH can get to 10K? Because actually, I have to tell you something about Milk Road. When you go to our YouTube as a returning user, the clip that opens is literally you with Jay a month ago saying, "Yeah, ETH can go to 10K."
It absolutely can go to. It absolutely can go to 10K. I think that the Tom Lees of the world, he's spinning a great narrative for his user base, which are TradFi allocators and heavy retail traders in the Western markets. And his thesis is, okay, banks all of a sudden now want to do Web3. The most secure chain to do Web3 on is Ethereum, and therefore either they'll build their own L2 or use L2s that are out there, or use the Ethereum mainnet in and of itself. And this is going to drive usage of the chain, and that's going to be the institutional DeFi narrative. And I like that narrative. Whether or not it's true is kind of irrelevant. I think it makes sense to the people that he's selling it to, and coupled with a supportive macro environment, this will be what generates ETH to the $10,000 to $20,000, I think, price by the end of the cycle.
Who's going to be happiest when that happens, or who's going to be saddest when ETH hits 10K?
The Ethereum Foundation, gotta keep dumping shit.
That's one of the longest crypto questions, is the meme of ETH to 10K. So we always got to ask. Okay, Arthur, we actually asked our Milk Road Pro community if they had any questions for you, right? You're very popular, and people wrote some essays, so I'm going to try and keep it pretty short. People wrote things. I'm like, man, you pay attention, and we have our community is fantastic. So we'll get to a question from Damien. He said, on a very recent Coin Bureau podcast, Arthur mentioned that Pump is one of his worst investments, down over 50% at this point, could be even more after the recent drawdown. Ask him if he is still bullish on Pump.fun and the meme coin narrative.
I mean, I got smoked so hard on Pump, I haven't looked at the chart since I sold it and took my L, so I have no fucking idea.
Oh my God. What do you think happened? What do you think happened at Pump Fund? Because that was, God, what a darling through the end of the summer, but it got absolutely destroyed.
So I don't know if they've rectified this, but the assumption was that they were going to use this revenue that they make to buy back the token. I don't know if they're doing that or not. Obviously, they weren't doing it at the beginning when the token just launched. It was basically max extraction. And so, I got smoked. And, I took my L, sold it, and moved on, and haven't thought about it since.
Speaking of another recent pre-sale, which I saw you were tweeting about, are you bullish or bearish on Monad these days? The big one from the first token on the Coinbase Launchpad. That's not a question from the community, but just a similar story of a pretty large pre-sale, but now up, I think, a 2x from their pre-sale price.
So I didn't buy it in the pre-sale. I bought it. I bought a bit of it in the secondary once it launched. I think I sold it a few hours ago. Okay. Again, if you read my X, you can see that I have no belief that this is actually a legitimate blockchain. I think it's probably another piece of shit, high FTV, low float, dog shit chain that'll never have any real usage. I don't think it's going to be able to compete with Ethereum and Solana. But again, I think it's going to make a lot of money for the founders and the VCs that are able to dump on everybody once things unlock. And, I was going to say there's a lot of hype around it. Every token gets a pump. So it had a good pump. I wasn't really feeling the chart and the energy. Like I didn't feel energized when I looked at that chart that you could really do more. Maybe it will. And I sold too early, whatever. I made, a decent return for a day and a half of risk. And I took my W, and I'm going to go off into greener pastures.
Congrats to you, man. See, this is what you're going to do. You're going to inspire some degens here, because you're just saying like, hey, I just hold your ETH bag, whatever. And then at the same time, you're like, oh, I just did a quick flip on some random L1. This man is not allergic to making quick money either, despite the long-term view. Okay, another question from Dazed and Confused. Ask Arthur what he thinks will happen with the January 15th MSCI decision. Jamie Dimon and the JP has said, JP Morgan has warned that exclusion from MSCI indices alone could lead to 2.8 billion in forced outflows with potential total outflows reaching up to 8.8 billion if other index providers follow suit. I think he went and got the quote. My concern is the avalanche of BTC selling, then of course alts, causing long-term damage. He's a bull. I'm assuming he's referring to you. It would be great to get his perspective, as in you.
I don't know what indices that MSCI is including, because they didn't make it to the S&P, right? I'm not sure if they're in the Russell or not. I think a lot of these large indices have sort of poo-pooed them and sort of not really added MSCI for whatever reasons. They have their reasons, some good, some bad. I think this is sort of a nothing burger thing, this MSCI exclusion or inclusion. I'm not sure whether they're in or not. I don't know if maybe JP Morgan's portfolio trading desk probably has a massive rebel position on the stock, and he's just trying to jobbo them into putting them in because they're going to make a fuck ton of money if they get included. I put that more as probable than anything else. Rather, like, why is Jamie Dimon opining on like MicroStrategy? This man runs a fucking trillions of dollars of like treasury positions and massive interest rate swap positions. He's talking about MSTR. Like, doesn't make any fucking sense. I think he's probably got a position, or one of his desks does, on this rebal. So, and he's talking his book.
Okay, so not a big deal. And Arthur's book's not a very big deal. Okay, got it. Okay, and this is from T-Pan. What's a simple framework? This is much broader. What's a simple framework he and his team use to evaluate an investment opportunity that's applicable for retail?
So I think retail probably is more concerned about liquid trading. And I think you really have to have a belief in what you're trading, because belief and use no leverage. It's just hard. Like, obviously we trade in the early stage stuff, but again, we get access to the best deals and we get the best prices because of who we are. And even still, we lose money on stuff. So I think if you're a retail person, focus on liquid altcoins that, have real organic demand because their product or service is useful, and trade those. Again, if you are not a professional shitcoin trader and you aren't in the Discord, on X, understanding the sentiment behind these things, can discern whether what someone says in a white paper is bullshit or not, just don't get involved, because you're going to get burned.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer. Okay, great. Thank you for that. That's I think a lot of it, what I'm learning from you, Arthur, is that unless you have time to do this 24/7 and be the absolute master, don't do it. Just DCA or whatever, just be bullish on the long term, and that's about it. One last question for you, Arthur, and this is unrelated this is not from community, it's not really from crypto, but I would love, we talked about the economy, we talked about more money printing, the larger macro picture. How is AI playing into all this? Because it's something that we haven't touched on, but obviously it is a massive part of the S&P and the Mag 7, or they prop up so much. So I'd love to get your kind of general view there.
The U.S. economy marginally is a bet on 7 companies and their ability to create this new utopia, or whatever you want to call it. And so when the Mag 7 falters, and now they're even issuing debt, right? So now we've gotten into, they're going to be integral into the corporate debt markets, which in one sense is bad, and in one sense it's good for us, because we know that when there is a wobble, then the authorities are going to rush to the rescue, whether that's executive orders about creating some massive nuclear boondoggle or semiconductor fabs or lending or what have you. But again, I do not invest in the AI stocks, because I think this is the railroad business. And investing in railroads is very, very difficult. I think investors, they want to understand what this could look like is take a look at if you invested in the things that China was investing in terms of industrial build out from the 90s until the 2010s. I think a lot of investors feel comfort that the U.S. government is behind them, whether that's through loans or through grants or through just a job building that Trump is constantly inviting these folks into the White House and, breaking bread with them. They say, oh, great, I'm investing alongside the government. Well, look what happens when an investor invested alongside the government in China. The government has political concerns over monetary concerns. Trump is more concerned about winning elections and jobs than he is about whether NVIDIA is a $5 trillion or a $20 trillion company. Obviously, you'd like it to go up, but if that came at the expense of a particular representative losing their seat in the Senate or the House because some project didn't hire enough workers, well, then he's going to support that. And so your interests as an investor are going to be a backseat to the political machinations of the government. And so, equity investors in China have made no money over the last 20, 30 years. You're flat. Except for specific stocks, if you're a stock picker. Take that as sort of a roadmap for what could happen in AI. AI could be wildly successful and lead to some amazing things that people and entrepreneurs create. But you as a railroad equity investor in the early stages could get absolutely wrecked in the same way that people got wrecked in Cisco and the fiber optic build out in 2001, got wrecked in railroads in 1907. Every major railroad of technology entices all this capital that usually doesn't make a good return. It's who invests afterwards the first crash who does well. So I say avoid AI. That not to say use the products. They're great. Wait for some entrepreneur to create the new Google of the, applied LLM model space, whatever that is. But I would be hard pressed to invest in NVIDIA and some of these stocks. Not that I would short them. I just don't even play the game.
What's your favorite AI product?
I'm actually liking Gemini right now. I've been trying that out more. I'm more of a Perplexity guy, but I've been really getting into the Gemini models. I want to try out the Claude stuff, the Excel models and all that stuff. So yeah, it's awesome. These are great tools. Like I love the productivity that they bring, but how these fucking guys going to make any money, I don't fucking know.
Right on. Arthur, you're a legend, man. Thank you for coming on the show. Always great to get your point of view. And we'd love to have you back in the new year. Even if you join us from a snowy mountaintop in Japan, you're always welcome back on Milk Road.
Thanks for having me.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why do we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.